Welcome to the Long Only Podcast. I'm Doug.
Jerry,
Jerry, how is it going today?
it is going well.
Excellent.
It is going quite well.
Well, why is it going so well?
The inflection that we talked about last time
Yes.
was inflected.
Yes.
They rang a bell, and the Fed got a clue that they probably have gone too far in interest rates and have now signaled that they're going to be lowering rates. And I honestly don't know why. I mean, I know there's all these discount models that value companies and there have been past periods of inflation, nothing like this in 40 or 50 years, granted, but past periods of inflation, higher interest rates where growth companies' stock prices did not get hit like they did this time around. Then again, they also had this ridiculous run in the 2020, 2021 era. So our time frame. So obviously it has something to do with that, but nonetheless, it does look like inflation has peaked. Don't get excited. That doesn't mean prices are going to go down to back where they were before COVID. You're still going to pay, $25 for a deli sandwich, at least for the foreseeable future. But it does look like the inflection point has been hit. And I hate talking about the Fed, but it's the focus on it has been so ridiculous. It's like you can't ignore it. You can't not talk about it. Hopefully we will get back to some semblance of normalcy. It does feel like that inflection is happening. I mean, we've had, without getting into numbers, the growth company portfolio has had quite a few days here where, I don't know, 4 times the return on the market. So, I mean, which is in and of itself ridiculous. But this is the world we live in today. Embrace it. Learn to live with it. It's the hand we've been dealt. We just have to play it.
In this segment, we're going to call not just crowing about how we appear to be right so far. I mean, let's face it, we're not that far into this. We've been fooled before. The difference is that this time the market kind of has the Fed's permission to go up due to the recent meeting. There's a little more.
Don't be surprised if they jawbone it back down again because they don't like seeing it. But I think the positive, and this is where I think we're going to get into what we really wanted to talk about today. The positive is that it's not necessarily that the market, quote unquote, has done all that fantastic in the last couple of days. What we've seen is just finally growth company stock prices have been, acting really well where they haven't for 2 years. Almost to the day. I mean, it was November of 21. And it was about 4 weeks ago, so maybe halfway through November, that the first real inklings after what we've talked about, like the 7th time we saw our growth portfolio hit a low, the same basic low for over 2 years, unprecedented as I can recall. So it was about 4 weeks ago that this started, and then the inflection has happened. The Fed made their comments this week. That they're recognizing the inflation numbers have been acting better, and that lower interest rates are on the horizon down into 24. And I think the market is discounting something like 75 or 80 basis points of lower rates. The next probably shoe to drop is, and we're already starting to see it, is economic numbers being worse than it hoped for. I still think there's a good chance that we could end up avoiding an all-out recession, but nonetheless, economic numbers looking worse than they are expecting, and then there might be a much quicker and more rapid drop in rates, which, again, I don't like. And this volatility and this focus on Fed and interest rates is insane. Let's get some policies in place that will actually promote growth. And then inflation will take care of itself. Growth will take care of itself. Stock prices will take care of themselves. Value will migrate to real economic value as opposed to the nonsense we've seen, frankly, for a couple decades. But we won't get into that today. What we want to get into is what, Doug?
I get to say the title.
Okay. Oh, you get to say the title.
I get to say the title.
Didn't I say what do we want to talk about, Doug?
We're going to talk about positioning yourself for a rally in growth in particular, but a market rally. You're going to correct me on the term market rally because you just said before we started recording.
Well, I think it's really important. I don't know that enough people have an appreciation for the common term when we say the market. I think it's fair to assume or fair to say that most people think of the Standard & Poor's 500 stock index as the quote unquote market. Whether that's adequate or not, we can argue from here to eternity. We'd have 150 podcasts on that. What I think most people don't understand is in a market capitalization weighted index, there's a mouthful.
Such as the S&P 500.
Such as the S&P 500, which means the largest valued companies, in other words, the biggest market capitalization, which is another term for the valuation of a company, the largest get the most weight in the index. And right now, we keep hearing about this Magnificent Seven, and I can never get it right. What is it? Facebook/Meta.
I don't know. Google. Tandy, MCI WorldCom, all the big ones.
Yeah. Now you're talking about the nifty 50 of the 70s. Although,
we got Facebook, Netflix, Google, Amazon, Apple, Meta, Tesla.
I don't think Netflix is no longer in there. Netflix was the FANG, but it didn't make it to the Magnificent Seven.
Oh, you're right. 2 days ago, NPR, my source for all things news related, and really truth itself, NPR, Apple, Amazon, Alphabet, NVIDIA, Meta, Microsoft, and Tesla. So yeah.
There you go. So those 7 companies have represented 30% roughly of the move in the S&P 500. I guess over the last year, that's probably been the case over the last 2 years or something close to that. 7 companies. I mean, when we say S&P 500, they're actually using 500 different companies in that index. But because of the market capitalization weighted aspect of it, and because we're dealing with companies that are measured in trillions, Apple, I think, is the biggest at 3 trillion or thereabouts. Am I right? I don't know. Close. I don't think enough people have an appreciation for how much that is, quote unquote, the market right now. Really, 7 companies, 7, not 500. So, and we've talked about this phenomenon before, and I think it's almost, I mean, when you get to I don't have the exact number, but when you get to like the top 10, it closes in on 50%. When you get to the top 25, it's almost the whole darn thing. And these are the largest of the largest companies. And there's no doubt in this environment of heavy-handed government, this environment of higher interest rates and inflation, this environment of high taxation, we've ended up with the largest of the companies, the incumbent. It's benefited incumbency. So it's benefited the large S. Might that be changing? I don't want to go out on a limb and say that, certainly from a policy standpoint. But what I think is happening at the very least is the quote unquote valuation mechanisms, the models, if you will, the algorithms that are out there running around and churning every day, valuing companies, probably now turns in favor of the growth side of the equation. Not to mention, if we do end up in a more recessionary environment, that's not going to equal heavy parts of the index or the indices that will be hurt more by an actual recession. Again, I still don't think that's necessarily going to be full blown. I think we're in a normal market or in a normal economy, and I don't know that we have one and haven't for a long time. But rolling recessions happen all the time. What do I mean by that? I mean, certain industries will be in recession where others are doing well. That's actually pretty normal. And most quote unquote macro recessions, I'm using these,
I got you.
Policy driven. They're policy driven, usually monetary policy driven. They make a mistake and it causes this, sort of almost systemic type of move. So I think that, just to wrap up on this segment, I think we've seen an inflection point. I don't like the violence of the up move, frankly, but that's going to be what we live with. Don't be at all surprised if 2 years from now we've seen this massive outperformance on the growth side of the equation. Just if nothing else, from what so many of the mathematicians like to refer to as a reversion to the mean taking place.